What's up, folks? Happy Friday, October 10th, 2025. My name is Hamilton. Joining us today, co-host Randy, and then eventually our new intern, Evan. So shout out, Evan came on board last week. He's going through the ropes now, kind of learning the process and everything else. Really a lot to talk about, actually, particularly this week. I think theme of this week has been volatility for sure. We were talking earlier today, particularly in the Discord. Some of the swings that we've had on some of these trades this week have been absolutely diabolical, but as of at least right now, it does look like we're going to be able to go ahead and close this week out strong. Now, I don't want to jinx it here. We have obviously still another half of the day to trade, but Randy, I want to go ahead and give you kind of the floor here before I get into kind of the agenda that we have. We have a bunch of first-time listeners today as well. Bunch of trades that we're going to be going through, charts in particular that they submitted, so we'll have fun doing that. But I want to go ahead and give you the floor here. Is there any kind of overarching theme or idea that you want to just get out right now? I know we talked earlier this week on Wednesday, kind of end of Q4, but particularly with this week, what stood out to you?
Yeah. Well, some of the individual names that we've got have pulled back some as the market kind of pulled back, but it's not anything out of the ordinary. I think what was most surprising to me was that we keep getting these like half percentage day moves, and everybody's just flipping out and everybody's freaking out. Obviously we had that reverse in crypto from last week. The whole theme sort of bounced back. And then we got a little bit of a pullback this week, and people are just flipping out. So the thing that's just most surprising is how quickly people are jumping from one extreme to the other. It's kind of insane. But with that being said, there's a lot of data that we've got to support a nice Q4. There was a great chart I saw this morning that was essentially overlaying what I was saying in regards to this expectation of a Q4. It was this guy who averaged out all of the years that had an exceptional Q3, and then put out the path of the Q4. It was like a seasonality chart. It was really cool. And what stood out to me was, we're going to expect a better than average Q4 because that's what the data is leading us to believe. But even then, we can still hit pullbacks, So for whatever reason, people are thinking we're just going to go straight up 90-degree vertical mentality. But markets do zig, they zag, and we're feeling some of that right now.
It's a great point. Sentiment goes a long way, but something that I stress inside of TTI all the time, and I talk through this with individuals and as a community, expectations, super, super, super important, right? I think expectations are arguably one of the most important things in the market because if you have a plan with conviction, things tend to work out in the long run. That, bunch of different variables when it comes to that. Your time frame. What type of price action are you trying to capture? If you're glued to the minute to minute, everything feels like the end of the world whenever something doesn't work. If you're, instead zooming out a little bit and you're looking to capture day to day, week to week, month to month, which is more RMO, these pullbacks represent buying opportunities. They do not represent freak out opportunities. Now, obviously, something that I joked around about yesterday, I saw a lot of people yesterday when the markets were pulling back a little bit. You always see the same type of people on Twitter like, oh, I would love if the markets consolidated here for a couple months. They would think that would be really healthy. Nobody making money says that shit. These are the people that did not buy when they were supposed to buy, and now they're wishing and hoping the market pulls back or consolidates so they have an opportunity to get long. When I read that stuff, I look at them as losers. They're losers. Nobody with a solid positioning in the market making money says, I really hope the market pulls back. Bunch of jokers out there. And I saw it everywhere yesterday on Twitter. I think that was like one of the main things I saw. And I take that into consideration because when you see that type of sentiment out there, the market will really overdue for a pullback. I think to myself, it's probably not going to happen. Look at how many people are complaining about it. And it's just not happening. We're continuing to melt up. Another thing is, which, adds complexity to the entire thing that we try to do here is if you're trading options, first off, it's not as simple as just trading the underlying equities, right? Equities, you have two things to worry about, really one and a half. One is price. Is it going up or down? Right? That's what you pay. If you're long, obviously you want price to go up, you're going to lose if it goes down. And vice versa. If you're short, you lose if it goes up. But also there's that hidden cost called opportunity cost, which it's hard to quantify, but if you're in a trade and it just doesn't do anything, you're not really losing, but you are potentially losing out on potential profits being allocated somewhere else. So we'll say like a 1.5 time thing. Now, in the options market, we can lose 100 million different ways. We have a bunch of different Greeks we have to worry about, Vega, Theta, etc. And one of those things that you alluded to, market pulls back a little bit. Well, if you're long options contracts, you're going to feel the crunch a lot more than if you're long the equities. So the market might pull back 0.5%, but let's say you're levered long through a bunch of call options. Those call options are going to definitely pull back more than 0.5%, right? I mean, that's how this stuff works. But the allure there is that you could potentially make a lot more money utilizing a smaller amount of capital. And we've done a very good job over the last 5 years developing a system to be able to do that. Some of the more outlandish profits that I'm able to post from clients are directly tied to the fact that we're trading options, right? It's just not something you can do from an equity standpoint. So you're right. Pullbacks in the market tend to bring out the worst in people, but they also tend to bring out the worst in the worst people. And expectations go a long way. If your expectations are the market, the way that we view it, what is trend telling us? Primary trend, intermediate trend, short-term trend, are they up? Probably going to continue to go up. What's market breadth telling us? What's momentum? And which sectors and industries are leading, which we'll get into in a second. As long as those line up, pullbacks are to be bought, not to be worried about, right? Okay, really quick before we get into anything else, I do want to point out that crypto in particular is a lot more volatile than the markets, right? So, and that's, part of the feature of trading it. The 5% moves per day in Ethereum is not a bug, it's a feature. That's why we want to be long those type of assets, particularly in a market that is rewarding holding those, which over the last couple of weeks has been tough, but still primary trends are up. So set your expectations. In reality, choose through whichever way you want. In our way, we obviously use a weight of the evidence approach. Which direction you think the market's going to go? Trade accordingly. Anything you want to add there before we move on?
You brought up crypto. Yeah, crypto is so far out on the risk curve, it's going to move the most. And you have people flipping out because they get a 4% day in Ethereum, and that's just what the average move is, right? So you really can't
talk about volatility and expectations all the time. Here it is, folks. For those of you that don't know, your average daily range, right, which is the average move from the top of the day to the bottom of the day, every single day right now is averaging 4.28%. So if we get a pullback day, for example, Ethereum drops 4.28% or 4% or whatever, is that out of the ordinary? No, it's completely normal. It's these massive days where all of a sudden you should be, taking notice. 8% day, 12% day, 2-3 times their normal ADR. That's when you're like, okay, is something actually wrong? As of right now, and this is just an example, but you can use this on any asset you're trading. If it's within the volatility, like the average norm of the volatility structure or whatever, it's ebbs and flows, right? There's nothing to worry about.
Yep, absolutely.
Okay, really quick, I just want to run through 30 seconds. S&P 500, all intents and purposes, momentum is strong, primary trends are up, short-term, intermediate, long-term trends are aligned. You can identify those however you want. We tend to just use a simple moving average structure, 20-day, 50-day, 200-day, right? Short-term, 20-day, intermediate-term, 50-day. The S&P 500 primary trend breakdown remains at 610, previous all-time high breakout, riding the waves. Momentum is still high. Qs as well, right? Primary trend breakdown, probably somewhere underneath 540, currently 612. Momentum regime firmly bullish. Once again, intermediate, short, and long-term trends aligned. We have the R2K working on an all-time high breakout, which I do tend to believe is going to stick. I think this is the beginning of a bigger move in the small cap space. Not only are the charts kind of telling us this, look at the momentum in the small cap space has been arguably stronger than the large cap space over the last couple of months. We use the RSI to kind of differentiate that. A very small little break in the beginning of August below the 50 RSI, but when something is range bound above the 50 and below the 100 for as long as the R2K has been, you have to assume that the bullish momentum is going to continue until that breaks. We call this a bullish momentum regime. It looks really good here. We're also trading into all-time highs. So also want to take into consideration that we're coming into our fourth year, right? Fourth year of this bull market. And the Russell 2000 and small caps have yet to really participate. It would be very unusual for the R2K to just not participate at all within this bull cycle. And I think we're on the cusp of that, right? Not only that, but we also have some seasonal data going back that the small caps tend to run end of year as well into January. And are we starting to see that at the beginning of October? Yeah, I think we are. So R2K looks fine as well. And the Dow Jones sitting at all-time highs, I think on the weekly here. Actually, we can just go and look at it. we have confluence across all 4 of the most major indexes in the market. We have all-time highs. Looks like we're going to pull back slightly a little bit here on the weekly in the Dow. But for all intents and purposes, we have all-time highs across the board. S&P 500, Qs, R2K, and the Dow. It's really hard to bet against this. If you want to bet against these primary uptrends, feel free, but it's a hard way to make money over the longer term. Anything you want to add here from a primary trend standpoint on these 4 indexes, Randy?
No, you pretty much hit it. I mean, there's no point in overcomplicating it. Trends are up. You definitely don't want to be short anything when it's at all-time highs. Definitely want to have exposure alongside if stuff's at all-time highs. I mean, this stuff really matters. The risk ratios, I don't think you have touched yet, but those are at all-time highs. So no, primary trends are up. I mean, nothing has changed.
I get it. I mean, there's always an allure. There's always a joker out there. I was just listening to somebody with over 100,000 followers earlier this morning talk about this, but they're talking about how you don't want to buy at all-time highs, and it's just statistically the wrong thing to think about. Trends tend to trend a lot longer than most people expect. That's how trends work, not only in markets, but in data and everything else. Strength begets strength. It's how this stuff works, folks. If you want to make a living trying to short the all-time highs, you're going to get absolutely chewed to shit. Eventually, there will come a day where price will hit an all-time high, and we will usher in the next bear market. But there's a lot of supporting evidence that needs to come in, and the simple fact that we're at all-time highs is not enough information to make that decision. Okay, so really quick, I want to move over to Koyfin, and I want to look at kind of our intermarket analysis, where we look at a bunch of different assets in the market and how they've worked not only over the last week, but over the last 3 months and the last 6 months. And as you can see, most assets have had a really good 6-month run. They've also had a good 3-month run on the weekly. Like I said, it's been a volatile week, right? Volatile week. We've had some big swings, not only in our trades, but also in the market. October, for those of you that are unaware, October has the most 1% moves in the S&P 500 out of any month. Say that again. October has the most 1% moves out of any month. We're definitely experiencing that. It's only October 10th, and it feels like we're on a roller coaster. But if we zoom out, like we do in TTI, and we look at the broader trajectory of trends, you can tell most risk assets, at least as of right now, are going to close up on the week, with the Qs leading up over 1%, growth ETF up over 1%, copper, which is great. You have the R2K, you have the S&P 500. So again, you even have bonds up 1%, right? Not a bad week to be long risk. I do want to point out, though, and Randy, feel free to correct me if I'm wrong. This week, did we do a lot of buying? Did we open up a bunch of... No, we didn't. Why? Because, the time to buy is before the market breaks out. We had a huge run on Monday, which is super funny. Because on Thursday and Friday of last week, you saw all the bearish tweets come out from some of the thought leaders on Twitter. They kind of pandered to the mob, like, if you're green, don't let a trade turn red. It's complete bullshit. Make sure that, you don't get greedy, complete bullshit. And then Monday, we get this huge gap up in all these risk assets, and everybody goes, wait a minute, I just sold everything on Thursday and Friday because all my favorite guy on Twitter told me to be careful. And then they missed the big gap up on Monday, and we've been chopping ever since Monday. Is this the type of week to open up a bunch of new positions after the big gap up on Monday? What do you think, Randy?
No, absolutely not. And the main reason why is because of how we employ the TTI framework and our use of out-of-the-money call options. Now, we don't usually, that's not our only play, but I would say that is our bread and butter, and we have a specific delta that we target and rules associated with that. But whenever you have a huge move like that, all of a sudden your delta goes up, Vega goes up, and it's just a big boost in option premiums.
You're paying so much more, right? You're paying so much more than the guy that just bought it the day before.
In fact, I think we took off a lot of positions this week.
That's what I'm going into next. Thank you. Let's segue into that really quick. So for those of you in TTI, you get these alerts every day. You understand what we did this week. For those of you that are joining us for the first time, this week has been volatile. I get it. Some people are up, some people are down, some people are freaking out, some people are looking at this as an opportunity. We're on the optimistic side here, where we expect an end-of-year rally. But I do want to point out that we were able to turn a bunch of trades free this week, excuse me. We opened up a bunch of these last week, targeting 2026 expirations. I'm going to say that again. We opened up last week, before the market rallied, a bunch of new positions. On Wednesday of last week, we opened up a plethora of AI bubble-related trades. As a matter of fact, we had 10 trade alerts go out, which is a very busy week. We normally don't do that, but so many setups were available prior to a big breakout. We opened them. We were able to turn 6 or 7 trades free this week, and we're on the cusp of turning 2 more today, plus profits. So I want to talk through some of these. Constellation Energy Corporation, Folks, for those of you out there that are in agreement that the AI theme is probably a pretty hot theme to own, there's a bunch of different components in that. It's not just semis and softwares, it's the energy providers, it's the utilities. So your grandparents' utility sector is not the same as our utility sector. You saw a lot of people earlier in the year say, how strong is this bull market if utilities are in a commanding lead? And at the time they were. Well, I want to push back and say, if you actually dive through the utility sector and look at the types of names running, it's not your Dominion Energies. It's not your old school 100-year utilities companies that are pumping out like historic, or not historic, but like the energy grids that your house lives off of. These names that are running in the utility sectors are directly tied to data centers. Constellation Energy Corporation, GE Vernova, Vertiv, etc. So CEG, we opened up off of a very basic breakout into all-time highs. We were able to turn that free yesterday, meaning it hit over 100%. We were able to take half off. We sold 2 positions in ARM this week. 2 shorter-term trades. We played the breakout up and over this fancy little horizontal level. And now we're 2 free positions, completely no risk in them for November. So if an ARM continues to run, we're up hundreds of percent in this trade already. We're going to make a bunch of money off of this semiconductor play. We were able to turn Dell free off of 2 days ago. We got the big pop up. We have January contracts. We expect all-time highs coming in on Dell. Another risk-free trade. We took profits on silver the day before yesterday, completely on accident, but I'm not going to be mad about it. We kind of timed potentially a local top there. We're able to take profits second time we're taking profits here on silver. We turned Dash free a couple of days ago. We turned AMD free a couple of days ago. We're on the verge of turning Vertiv free, which is another energy-related AI play. We are on our second profit target in Intel, which we were able to buy down here. This is up. Some of you guys have 1,000% winners. I think I'm up 400%, so I got a bad feel. But the reason why I'm bringing this up here is not to necessarily gloat that we've had a great week. It's to prove to you guys that even though the markets feel like everything is, is falling and everyone's losing a bunch of money, it's simply not true. Something that I had talked about in a newsletter, and Randy, I want you to potentially expand on this in a couple seconds here, is the everything market. Like on Monday where everything was ripping, I tend to think, that's where this week starts, I tend to think that those are the harder markets to trade. And I tend to think it's because people get tied up in trades or breakouts that might not be the right trading vehicle to take at the time. Do you want to go ahead and maybe expand on that idea?
Yeah, absolutely. I think honestly the biggest cost that traders face that is not really realized is opportunity cost. And when you've got multiple things working, you can very easily be distracted on putting your money here or putting your money there, and then all of a sudden you've opened up 25 positions at 1% risk on each of them. And that's just not the way to go about it. Some of the best traders, some of the best investors, I think back to Drunken Miller. I think you were talking about him on Wednesday, actually. He has a few concentrated positions in his portfolio, the ones that have the ones that have the highest conviction in it, the themes that have the most supportive evidence to play out, and that's where he puts his risk towards. And when you have a bunch of stuff working, it's easy to put your money here, put your money there, put your money over there. I'll give a really quick example. Over the last month, we've seen, and I'm really happy you didn't touch on this, so I can talk about it. But over the last month, we've seen a spike in healthcare, and some people are like, "Oh, this is healthcare is going to turn here. Healthcare is up like 4%, beating the market or whatever." When the market is so strong and everything comes up like that, you can have this illusion of, okay, this sector is beating the market, so let me go put my money here. When that's actually not the right play at all, or maybe not the smartest play, I should say. Whenever you're in a risk-on regime, you want to go where the juice is. You want to put your time and your efforts towards the setups that look the best, but are also the ones that are the most risk-on. So this is stuff like industrials, stuff like communication services, which has worked really well, and technology. You don't want to be sprinkling your trades here and here and here and here and here just because everything's working. You want to go where the juice is, Super
important. And, I joke around about this on Twitter, but, Twitter is notorious for this, but really any social media, I call them chart monkeys. And it's the guys that will scan for breakouts using any scanner, FinViz, whatever. And then they just post 7,000 charts a day. And they're like, this is breaking out, and this is breaking out, and this is breaking out. And I get that. You're in your first year of trading. You're excited. You're learning what a breakout is and that you could potentially make a couple bucks. But I'll tell you, over the long term, owning every single breakout in the market is a great way to underperform, because most breakouts should not merit your capital. Side of TTI, and by the way, we're not perfect on this, and I'll touch on this in a second. I know we've had a pretty good week this week in the face of a lot of adversity and volatility, but not every trade has worked out, and I'll get into that. But if you can consistently focus on parking your capital in the best possible situations, the best possible breakouts or pullbacks, whatever, the odds of you making a lot more money go up exponentially. So I can give you a great example. Energy, right? Energy it happens every year, folks, and I'll be the first to tell you. A couple years ago, we made our greatest trade in 2022, the bear market, was going long Chevron. So imagine that. Our greatest trade in a bear market was going long energy, also the dollar, but energy. Since 2022, energy has sucked. There's been pockets, like a week or two of overperformance. We've made some money on names like MPC. Marathon was a really good trade, I think, in 2023 for us. But overall, the sector has just absolutely sucked. And I'm not even sugarcoating that. As a matter of fact, you can see it on the screen here. Going back from April 7th to today, energy is one of the worst performing sectors, along with healthcare, real estate, and staples. That's what you would expect in a risk-on environment. Tech is leading. It's basically been tech and everything else. Everything else, as a matter of fact, has underperformed the index. So, shout out to Chart Life, Ian McMillan over on Twitter. You want to beat the market, you got to own the things beating the market. Lo and behold, it's been tech and everything else. I want to give an honorable shout out, though, to comms, industrials, and communications, because those tend to be the top 4 plus financials, top 5 sectors that lead in a risk-on regime. And that's what we're seeing, right? So great example of having your money tied up in an underperforming area of the market is energy. And we sent out a newsletter yesterday. And I think it's super important because, people are going to get offended. You talk shit about somebody's trades, not directly, but even indirectly. You're like, hey, I don't see the allure with owning energy here. If you're long energy, you're going to take that as disrespect. And you know what? That's totally fine. That's what makes markets. People are going to agree and disagree. That's what makes buyers and sellers. The long-term goal is to move money from the disagreeers into your pocket if you're better than them. And it's gonna work out over the long run if you have edge. So the energy trade from April 7th to today, there's no ifs, ands, or buts. The dirty energy, the oil names, right? XOP, OIH, AMLP, the 3 major industry groups within the energy sector, have underperformed the broader index. And then if you go and you look at the higher beta, AI-related clean energy trades, they have not only beat the index, but they've beat the pants off the dirty energy plays. So again, you can be gung-ho. Oil's going to rip. I got to own energy. That's fine, but that's a bias. Go where the strength is. I don't particularly give a shit that clean energy if it's better or worse, if the companies have a future or not. As a matter of fact, you'll notice that in bubbles, which arguably we're in right now, at least in the beginning of a bubble, scams tend to rip a hell of a lot more than companies that actually have a future. But as a trader, I don't give 2 shits. My goal is to capture price action on a chart. It's not to bet the farm 20 years down the road on whether or not a company is going to exist. Right now, we've noticed over the last couple of months that clean energy has absolutely outperformed dirty energy. Great example of this idea or concept that Randy was just talking about. If you parked your money in energy, the dirty part of it, you've underperformed. And that is something you have to work on as a trader. Because as soon as you realize that you have your very scarce capital, we have scarce capital. We're not Musk. We don't have hundreds of billions of dollars to throw at everything under the sun. We have to be very, very cognizant. Every dollar we put in the market should have a purpose, right? And the purpose should be to capture the greatest possible opportunities we can. So this is a good, absolutely great way to prove what Randy was talking about. Anything you want to add there before we move on?
No, I think you pretty much nailed it.
So April 7th to October 10th, here's what the sector performance looks like. And then if we go and we actually look at the rest of the industry groups as well, you're going to notice that this year in particular has been relatively different, I guess. Strange, a little bit here. Very rarely do we have a year where you have gold miners neck and neck with semiconductors in a strong bull market. And that just goes to show you that if you have a bias coming into the market and it's not confirmed by price, you're going to miss out on some of the greatest opportunities. Good example is we were buying miners in January and then we bought more miners in March. They were breaking out. The market was pulling back in March. Everybody was freaking out. Listen, I'll tell you, it was not easy buying names like Agnico Eagle Mine, AEM, or Kinross Gold Corporation, KGC. Those are 1,000% trades right now. Was not easy to buy those in January or March, excuse me, when everything was crushing. But we did it anyway. And then those ended up being some of the best trades we put on. And here you go, going back to April 7th, clean energy. Who had clean energy leading off of the market bottom on April 7th? Not me. And yet we have positions in it. Metals and mining. Who had that ripping off the April 7th lows? Not me. Semiconductors, gold miners, solar, software, internet, jets, and then the S&P 500. If you're vested long in large positions in regional banks, biotech, retail, oil, water resources, home builders, whatever, you've underperformed. That is not bias or opinion. That is actually what's happening in the markets. So again, to give credit where credit's due, Randy said it best. Do not park your capital in areas that aren't performing as well as the market. Go for the winners. Okay, I want to go through some charts really quick that people had asked to go through. Looks like while I'm sitting here yapping, the market has pulled back significantly. Welcome to October. Let's go through a couple of these trades really quick. Some of these we have positions on right now. Some of them we don't. We have CrowdStrike breaking out into all-time highs. I know this is a trader favorite. The only thing that I don't like about CrowdStrike, if you're trading from an option standpoint, is that it tends to be kind of a tough trade from an options standpoint because the contracts are super expensive and the liquidity can sometimes be a little iffy. So spreads can negatively impact this, but from a charting perspective, CrowdStrike does look fine. It's a market leader in the cybersecurity space. You're in an AI tech-related bull market. Why would you not want to own something like this? I think it makes perfect sense to want to buy a breakout above 515 if you want more exposure in this area of the market. You're within a bullish momentum regime going back from April, riding the primary trend higher. You want to buy it. It's hard to argue against this. Is it my favorite trade? Probably not. Randy, anything you want to add here from a chart perspective on CrowdStrike or any other name that's adjacent to CrowdStrike that you can think of?
Yeah, the line in the sand for CrowdStrike is obviously all-time high, so that makes the trade easy. I would wait for a close above 515 though, absolutely.
It's easier to buy the all-time high breakout and then throw your line in the sand underneath it and just say, listen, above it, I'm probably right. Below it, I'm probably not. It sounds stupid, but for those of you that have been through the last couple of market oscillations in TTI, stupid tends to work pretty well. Simple tends to work pretty well, right? Take the easy trade. You don't need to be, there's no awards for taking the hardest trade. It's all about just making money. Archer, another one that we actually took some short-term trades on. I'm going to go ahead and delete this because they're not relevant anymore. But we did make a bunch of money on Archer in the short term. Now, I know this is a meme stock. I do want to point out we didn't talk about this in particular, but ARC up into 52-week highs. We also had the advent of the meme ETF come back out. Listen, I'll tell you right now, folks, this was an ETF that already existed and it failed. And they're bringing it back. I don't know if that signifies closer to the top than not in some of these high beta meme stocks. But I also want to point out, shout out Mr. Dave Portnoy, who showed this incessantly in the last bull market, Buzz, which essentially does kind of the same thing memes trying to do. Social sentiment, high beta stocks is up into all-time highs today. Archer fits that theme. Is there anything you want to add here to Archer other than this is just a high beta meme stock? It tends to correlate high with ARC type of trades. Is this something you're interested in? Is this something that you'd rather just watch? What do you think about Archer, ACHR?
I think it's such a low cost stock. I mean, so the options on it can't be that expensive unless the volatility is super high. But again,
Probably
you have
is.
a very,
Matter of fact, I think
yeah,
we look at it.
yeah, it probably is. But you have such a clear line in the
It's less
sand
than
here.
I thought. But yeah, I mean,
What
it's
is it?
for the November is around 100. For the January is just under 100. I expected like 150. So this is still high. Don't get me wrong, but I
Yeah.
expected way more.
Yep, still high. I didn't even know this, but it's in the aerospace and defense theme, which is honestly, I think, a working theme, a working industry group for the past year.
These
I
guys
think,
like don't. Oh, maybe I'm mixing this up with JOBY, but don't these guys make like? Yeah, they make personal aircraft shit. So you want to go buy your
okay.
own personal airplane? I guess Archer's the way to go.
Yeah, but there's such a clear line in the sand at all-time highs. I mean, it makes it makes it easy. Again, though, I'd wait for a close. I'd even wait for it to go a little bit above all-time highs because these kind of meme stocks can just be crazy with intraday moves. They can have some serious fake outs to them. So I'd wait for a close. I wouldn't personally get in this, but the chart looks good. And at TTI, the setup is all about, when we refer to setup, we're just talking about something that gives us a skew when it comes to risk reward. At the end of the day, that's all a setup can give you is, can I make more off my winners than I can lose over my losers over a series of time? And all-time high breakouts are very simple because you can just place a stop below them. I wouldn't personally get into this one, but I mean the setup does look like it's there.
I would say it's not all-time highs because we have price action back in the late 2020, but I get what you're saying. Something above 13.40
Oh,
if you want to take it. It's totally fine.
yep.
I'll tell you, end of Q4, or not end of Q4, but into Q4, high beta shit stocks tend to really run if the market is hot, which we saw in the end of Q3. I wouldn't be surprised to see Archer continue to pop along with like this entire theme. I think that's a bigger thing. The company itself making personal space craft or whatever the hell it is. Listen, if you want to buy into that, God bless your heart. It didn't work last cycle. It's probably not going to work this cycle. But from a trading vehicle standpoint, they can offer short-term high beta setups that you can make. We call it grocery money inside of TTI. You take these short-term setups targeting, for example, the November 21st contracts. You might make 100, 200, 300%. You throw a couple bucks at it. That's grocery money for the month. But not something I'd probably bet the farm on. The next one, which I'm actually long, we got long this last week. New Scale Power. This is essentially the same type of setup as CEG, GEV, VRT. We're looking to capture that AI energy theme related trade. Now, this particular setup, arguably less bullish than CEG, VRT, and actually I think GEV actually looks better than this, but I got long this one off of the bullish momentum regime. It was favorable for me because I was looking to throw some call debit spreads on the book, so I bought the call debit spread in SMR. I don't think there's anything wrong with this particular setup. I think the cut somewhere below 35 makes the most sense. As of right now, we're just waiting for the trend to continue to kick this to the upside. Anything you want to add here?
No, pretty much nailed it. But I will say, just in general, because you mentioned call debit spreads, and this is actually what I did with Ethereum. If you're like somewhat nervous or hesitant about some sort of pullback or whatever, or you want to be involved in a stock and not necessarily wait for some sort of market pullback, which I mean we never wait. We always, whenever we see a setup and it fits and it's conducive to strong sector strength and relative strength and everything like that, we won't necessarily wait for a market pullback. But you don't have to go super aggressive. You can implement call debit spreads, and that would cut your debit not in half, but it would significantly lower the price or the cost of the overall trade. Now, you're not going to get the infinite upside, but as the setup plays out, as the setup works in your favor, if the market turns around, then you can add on to your winners. And I'm seeing a lot of conversations actually within the Discord of people talking about adding on to strength and how they've never done it before, and it's kind of been a game changer. But that's just one way you can do it. And that's actually what I did with the Ethereum plays. I've gone in with a call debit spread because we didn't break all-time highs. And as the trade works, as the theme develops, if we get that type of strength that we're looking for, then I'll add with something like a flat out call. So you don't have to go all the way with just a flat call because those generally are risky. But something like a call debit spread would be a nice sort of starter. I guess you could think of it as.
Call debit spreads are great. And, there's obviously, as you said, there's capped profitability on those things. And so a lot of people don't like to trade them. But once you realize that not only do debit spreads give you the opportunity to participate at a lower premium, they also hedge against a lot of the Greeks that tend to eat people up, particularly in higher implied volatility regimes. If you just want to get long, you don't feel comfortable selling something or whatever. Call debit spreads give you a hedge against some of that because you're selling a call along with buying a call. Put debit spreads as well, right? So no,
you also have lower theta too.
I mean, yeah, so it's a good sideways. It's a great trading vehicle. I don't think enough people use them. I use them extensively. I like them a lot. I like being able to clearly define my profitability. 4-to-1 or greater is what I like to target on these. But yeah, something that I implement religiously, right? Call debit spreads, put debit spreads, etc. So, okay, let's continue to go on here. I don't know if some news came out. I haven't checked it or whatever, but it does look like market's now down 1%. Look at that. October, fantastic stuff. PRIM was asked to be looked at. I got nothing for you here. This is a strong uptrend. It is not something that inside of TTI we would like to get long here. But for sake of conversation, what we like to do is we like to get long these breakouts. I mean, it's very clearly once we recovered off of the April 7th low. This chart looks a lot like Roblox, looks a lot like Robinhood in terms of the pullback into the April 7th low and then a reclaim of the 200-day moving average, which we did get long Roblox and Robinhood again off that reclaim. Prim, we did not. Looks like we probably did have. I don't remember this particular position. It does look like we might have played this earlier, either in 2024 or early 2025. I don't remember, but we would have got long somewhere above probably $85. I mean, that's a TTI setup as of right now. Nothing to do here from that perspective. RCAT looks, it's same argument as Archer. These are high beta. This is a mid-cap, small cap software-related stock. You know, these types of things are grocery earners. You don't want to go out and bet the farm. This is probably a good equities trade. I would imagine that this is well over 100% in implied volatility, meaning you're playing with dynamite. It is. You're playing with dynamite buying calls here. Unless the market absolutely rips RCAT, you're going to lose off of IV Crush, right? So if you want to play this, something that I don't think enough people utilize is the concept that when you're trading options, and goofballs on Twitter and YouTube don't get this because they don't actually trade any money, but you can clearly define your risk when you're trading options by utilizing the premium that you pay for the contracts. Meaning, if you're not willing to lose more than $1,000 in a trade, don't pay more than $1,000 for the trade. Meaning, if the trade goes to zero, you can't lose more than $1,000, but that's what you were already comfortable losing to begin with. So a lot of people like to say, well, you got to use a stop loss on an options contract. No, you fucking don't. You can clearly define your stop loss or your max loss through the premium that you pay for the contracts. You're not trading an equities related play. That's the difference between options and equities. Equities, you need a stop loss because very rarely are you willing to let that go to zero, right? You have a stop loss on the books, lose 5, 10, 15%, whatever your stop is. From an option standpoint, you don't need a stop loss. You can literally let these contracts expire worthless because the premium you paid is the inherent stop loss. The reason why I bring that up is if you're trading some of these high beta, high risk, high reward setups like RCAT or Archer, the way I would structure the trade is price it to go to zero. Meaning, if I don't want to lose more than $500 on the trade, I would only buy up to $500 worth of contracts in the goddamn trade. If it goes to zero, totally fine. That's what I had baked in for my risk anyway. If it works out, even better. I love making money. RCAT, not something I would personally touch, but that's the way I would play it from a risk standpoint. Whatever you're willing to lose is what I would get into that. 2 more trades really quick, and then we're going to call it. Pony here is a trade.
Evan's also in here. Sorry, Evan's also in here. So if you want to add anything, you can obviously jump in whenever.
Yeah, feel free to jump in. I didn't know you were in here. Evan, once again, folks, for those of you that don't know, Evan's our new intern, started last week. He's learning the ropes. So far, so good, I hope, Evan.
Yeah.
Pony.
Great so far.
Great so far. We do things a little differently, but it's consistent and it tends to work over the long term. So I think you're going to be pleasantly surprised. Let's talk really quick about
absolutely.
Pony. Kind of like the ARM trade, right? So ARM, for those of you that are in TTI, you know this. For those of you that don't, we've opened 2 positions in ARM. First position we opened, if I'm not mistaken, was the November 170 calls. We were able to turn those free after like 1 or 2 trading sessions, which does not happen often. Then we were talking about getting long ARM again. Like we like the setup. We're at the top of a range. You throw your VRVP indicator on. You can see if it loads. You can see that there's clearly a gap in volume heading up into all-time highs. It's in the right sector. It's in the right industry group. We like this particular setup. So we talked about wanting to own more. We want to go and grab exposure into 2026. The problem is the options contracts weren't accommodative, which again, for those of you that trade options, the chart is only one part of the trade. You have to have an accommodative setup on the options chain. Otherwise, the trade won't make sense. That's what makes options trading harder than just trading equities. But along with being harder, there's potentially a lot more reward. So we said, listen, I know we want 2026 exposure in ARM, but there's a potential setup here to get more long the shorter term contracts. And if we can get those into the all-time high breakout, maybe we can use all of the profit we make on the short term to finance the long term. Therefore, we're not risking any account capital. We're only risking profit we made on the 2 short-term trades. So a couple of days ago, we went ahead and we opened up the ARM 190s and we were able to turn those free same day. Now, I'm not going to bullshit you. Very rarely does that happen, but we got it. So we now have a 170 and a 190 tranche of calls expiring in November. Both of those are worth over 100% with risk taken out. Everything that's still left in ARM is house money. We're going to let those continue to run. The reason why I bring that up is we did the same thing with Pony. The problem is the first contracts turned free. So we were able to flip those free. And we said, listen, we're up into all-time highs. We want to continue to play this. It's in the right area of the market. Chinese stocks are working. We have great positions in Baidu, great positions in Baba, XPEP, Billy, to a lesser extent, great, but still we have exposure. The Chinese trade is working. This is a Chinese AI software related trade. The first trade worked. Let's go ahead and use the money from the first trade to finance another tranche. Same thing we did with ARM. The problem is this one has not worked out in the same way ARM did, at least not immediately. Now, one of the things that I like to preach is that if we're trading these short-term trades, again, I call these, grocery money, grocery earners. Every Wednesday, we have a session where we exclusively look at these types of setups going out anywhere between 30 to 45 days. Our MO is really weeks to months, sometimes up to 6 months. But these short-term trades can finance those longer-term trades. So on Wednesdays, we go through and we go, what can we utilize in the short term to finance these? And what we decided on was just opening up another tranche of PONY. Fit the theme, we already had a free position on, and it hasn't worked. So from a trading management standpoint, I like this still above 20. It hasn't moved the same as the first tranche, but the trade is not invalidated until we break below the breakout point at 20 bucks. Is it fun to hold a trade that isn't working? No. Are we going to win every trade? Absolutely not. But over the long term, these things tend to play out in our favor as evidenced by positive equity curves. Now, Evan, you just came in and Randy, you're a year into TTI, which while you've definitely earned your stripes in here, you're still kind of new to this overall idea of not only options trading from a swing trading standpoint, but also from the types of profits that you see in TTI. You joke around all about that, you just came out of college a year ago or so, and you said this type of stuff, in your financial courses and stuff, your professor said it would never happen. You couldn't see returns like this. And yet here you are a year in, and not only have you seen it from clients in TTI, but also you've experienced it. What would you tell somebody that owns a second position in Pony that is underwater on the position, but the trade is still valid from a technical standpoint?
Just let it play out. Let it work. I mean, you're not going to know it would be great if we knew which setups would work. But at the end of the day, it just comes to how much you make on your winners versus how much you make on your losers. And by looking at the market, by stacking probabilities through relative strength work over the sector, through relative strength work of the stock, through finding these points on the chart that give clear asymmetric payoffs. That's how you set yourself up for that. And the stock you mentioned pulling back, and it is along with the overall market, but the setup, has anything materially changed? Are we still above that risk on level? Absolutely. And some of these trades take time. I mean, very rarely, you said it earlier, do you get 100% in one day? Well, you don't always hit these stocks that just keep going up like vertically. My last one was actually the whole quantum theme that just actually gold too, like worked almost immediately as soon as I put it on, but it's not that common. So you got to let the trade ebb and flow a little bit, which is why you have that sort of defined area as like okay, this is where I want to reconsider taking the trade off. And some of these trades play out over a course of months instead of weeks. So Pony could very well just pull back, consolidate a little bit, and then start the next leg higher. So I wouldn't be too concerned. I don't know if I would add in until that starts reversing and starts working, but the setup is still there. You still have an asymmetric payoff, and that is what is so great about utilizing options. So I got an undergrad in finance, and these types of P&L swings that I see and that I experience myself are something that is unheard of in the finance realm. I mean, it's crazy to see people inside the Discord flip trades to 1,000%. And that doesn't happen all the time, but it happens more than you would think. And that's great because these huge winners can pay off all the small ones that don't end up working.
Exactly.
At the end of the day, That's what it comes down to is, are you making enough to where you're funding your other trades? And not all the trades are going to be good. I have a position on Grab right now. Great chart. It's pulling back. I'm underwater in that position, but I've made so much off of my other trades that I can afford to lose this same setup dozens and dozens of times. And all you really need are those few hits that you'll get throughout the year. And sometimes those come sporadically through months, through weeks, or maybe just even a day. But that's what it comes down to is, are you making enough from your winning positions to fund your losing ones? And with this type of system, I've been here for a year, but it works.
The only thing I'm going to say is it also comes in spurts, right? So markets move in spurts. You'll get a bunch of action all, in relatively short period of time. And then you'll get some sort of market consolidation for a longer time. So you'll see that the market will, I don't know, where spurt up, 2, 3, 4%, and then it'll consolidate sideways and then maybe pull back slightly and then spurt back up. If you're in a position doing those spurts, like we saw, by the way, we started getting long the market late April, early May with size, right? So we were testing the water late April above the 200-day moving average, and the breadth momentum thrust that we got long with size early May. We had, and for those of you that are in TTI, please back me up. We had like 10 1,000% winners in a row. I mean, it was just like everything we touched was ripping to 1,000%. And that's not because, we're the greatest ever or whatever, but it's simply because the market was absolutely ripping in the face of everybody. I mean, nobody expected the market to do what it did. That's one of the caveats of being in TTI is I'll be the first to tell you, I don't know what the fuck's going to happen tomorrow. I don't know what's going to happen a week from now. The only thing I know is that I'm going to ride the trend, whether it's up or down. And trending markets tend to continue to trend. When you can match that up with supporting evidence through breadth and momentum and relative strength and everything else, it tends to work out in the long run. But the market spurred up from April all the way through like June or July before cooling off, and we had a run where we had like 10, 12,000% winners in a row. So again, yeah, you're absolutely right. You make more than you lose over a larger sample size. You're going to make a bunch of money in the market. Pony, if it doesn't work out, it's fine. We have one trade on that's completely free. The other one is cost of doing business. Last one I want to talk about really quick is LMND, which actually is coming up on a stop loss here. I think it makes most sense from an LMND standpoint to probably close, if we do close below the 49, 48.50 area. What we're looking here is to ride a primary trend to the upside, which unfortunately is up, but in the short term, LMND has yet to catch a bid. This is one of those ARC style high beta trades. It's a fintech insurance related company. We still have a bullish momentum regime on the books, but once again, you're not going to nail every single winner. And with today's big pullback of about 8%, we'll see where the market decides to finally stop. We're down almost 2% today. We were up when we started this conversation 42 minutes ago, 52 minutes ago, and now we're down almost 1.5. I don't know if the world's ending or not. Some news might have got hit, but yeah, LMND is probably going to be a cut below 49. Don't lose your enthusiasm. Just cut and move on, right? Who knows? Maybe LMND is a setup again, but I think the main thing here is to not get caught up in losses and continue to move through the market without a loss of enthusiasm. Because as soon as you start to lose what is most important, which is obviously trend, relative strength, and momentum, that's when you start to give in to the Twitter demons that are going to tell you that the world is ending every other day. And trust me, I hear that every day. There's always a reason to sell everything until you go and you look at the S&P 500. And you think about the fact that, like, for example, the Qs are up like 50% off the April 7th low. Has not been a good year to sell everything. Parting thoughts here, Randy. Evan, I want to give you an opportunity to talk really quick too before we end this. Anything you want to talk about in particular about this week?
Yeah, I can go first, but I think it's just in the age of short attention spans. You say it all the time in the Discord and the market research portal. It's important to zoom out. And the market's going to go down today. You can go on Twitter and probably going to see a bunch of doom and gloom posts when in a month will probably be higher. So it's important to really zoom out and just manage the positions you have. If they're above your risk on levels, just stay with them and play the long game.
Yep. I second that. Look, we've got a lot of evidence that supports a great Q4. And, markets do pull back. I mean, that's just a function of markets. Things don't move up or down in one way. And so a lot of us, I know we've made some absolutely killing trades over the past few months, really since the April lows. And let's, think the worst. If markets do see a substantial pullback, that will hurt the account. I mean, there's no way around that. But we've made so much. We can afford these little paper cuts onto the account. So I'm certainly with the bias that we're still going to see a strong Q4. A pullback is fine. If anything, it helps give a way to monitor relative strength through some of the leaders and have other stocks set up that we can play. So, I mean, trends are still up. There's nothing that has changed within the past couple weeks. So if we get a pullback, that's fine. I will be buying the dip. So, yeah.
Yep, I agree.
Last parting words for me is, for those of you that aren't in TTI, one of the biggest things you can do is manage risk to the upside. Meaning, I'll give you a great example right now. Markets are pulling back. Looks like the Qs might be down 2% in a second. This week, we've been able to turn trades free, meaning closing half at 100%. A bunch of them, 4, 5, 6, 7 trades we turned free. So even though those individual positions are now going to be hit with the market pullback, we've already removed our original risk from the trade. Meaning, if these trades do not work in the long run, we lose nothing other than a couple bucks in transaction costs and opportunity costs. I think it's super important to understand that. Even though we're in a trending market higher, and even though you think you're in absolutely the best positions ever, you always want to be managing risk to the upside. It's not just to the downside. If that means removing capital from a winning trade to cover that original risk that you put in the trade, it absolutely helps you during market pullbacks, because particularly not only on the account side, because you've already shoved that money back into your account, but also from an emotional standpoint. If you just have 10 open positions and all of them are up 3, 4, 500% or whatever, let's say you just absolutely nailed it, and you haven't taken anything out, these types of market pullbacks right now, you might have your open P&L cut in half. These things might be down 50% by the end of the day. That's the nature of options trading. And are you able to stomach that type of volatility, that P&L swing based off volatility? Most people can't. That's not bad, by the way. That's not bad. So what we like to do in TTI is we like to manage our trades to the upside. We're always cognizant of where should we be taking risk out of this particular trade. We have price targets that, obviously make sense to us based off of risk to reward and math, fibs, as you can see on the way up. But also from an account management standpoint, we always want to be in the idea of defense wins championships. How can we pull money out of this trade while still making money to the upside? I've found out that over the last couple of years, closing half at 100% has been an absolute game changer for most people, because it allows you to emotionally detach yourself from these pullbacks, because it's not as big of a kick in the gut, knowing that you've already taken your original risk out. Okay, so this was a lot longer than we expected, 60 minutes actually about, which is great. I answered a bunch of your guys' questions. Thank you so much for emailing me those charts. For the rest of you that are inside of TTI, I'm going to post this over on the market research, and I'll talk to you in the chat room. We'll talk about this pullback in about 20 minutes. For those of you not inside of TTI and you're interested in what we deliver, you saw what we talked about here. You saw the market research portal about 30 minutes ago. All of the information is in the newsletter. So if you're interested, feel free to reach out. Okay, Randy, Evan, thank you so much for helping me out today. For the rest of you guys, enjoy your Friday, and we'll reconvene next Friday for the next TTI Weekly Roundup. Enjoy your weekend.
Take care, guys.